Hey, what's up, Agents for Life? Welcome to podcast number 262, where we're going to get into the nitty gritty and the numbers and a spreadsheet and a calculator on term versus whole life. Okay. How I talk about those with clients. And the big question that we're going to try and solve here today, which one is actually less expensive in the end? So, with that, let me share my mic drop thought first for the week. I heard this several weeks ago and reflected on it many different times since then because it's just a really interesting way of phrasing it. Now, listen to this. Happiness is amazing, so amazing that it doesn't matter if it's yours or not. Wow. Think about that for a second. Happiness is amazing, so amazing that it doesn't matter if it's yours or not. And when we give away happiness, don't we create our own? Have you ever served at a shelter or, some underprivileged facility or something where you're just giving for a few hours? How do you feel when you walk away? Giving creates. If you have a candle with a flame and you have another candle that doesn't have a flame, and you pass that flame along, it doesn't take away from the first candle. You give the flame and it adds to. And I really think that's how happiness operates. And when we go into our appointments, just trying to do the right thing for the client, not worrying about our commission and not worrying about our income, we get to create that atmosphere of trust and happiness. And we're going to come away winning either way, right? So we have to embrace that. I love that idea that happiness is so amazing, it doesn't matter whose it is. Because by sharing it, it's going to make you happy by default. So, anyways, very cool. All right, so I have a little spreadsheet. We're gonna jump in now to the calculator part, the term versus whole. And I have a little spreadsheet that I've developed that I use for this calculator. So if you are on YouTube and you're watching this on video, you're gonna get the added benefit of seeing this calculator. If you're listening to it, that's fine, but there's a link to the YouTube. You want to go in and probably check it out so you can see the visual. Just FYI. But if you're on YouTube, you're seeing right now a shared screen of a calculator that I have developed just using a spreadsheet that shows term versus whole. Okay, this is what we're going to get into. We're going to answer this question: which one is more expensive in the end? This is a little exercise I walk through with my clients. Felicia, this is an actual example. She's 33 years old right now. 5 years ago, she got a term policy. Forrester's Financial, strong foundation, $30,000, and she got a 30-year term. And her monthly premium on that is $14.96. First of all, she needs to know that she's renting her life insurance. She is. And that's what term is it's renting. Just like your car insurance, and everybody gets this analogy, so I like to use this. Just like your car insurance, if you don't get in a car accident, it's not paying out to you. If you switch companies or cancel your car insurance, you get nothing back. That's how term operates. Okay. And the reason I like to use the word renting is because there's another analogy that a lot of people are familiar with, the difference between renting and owning. When you rent an apartment and you leave, you get nothing back. Okay. Maybe your deposit, but there is no equity being built. When you purchase a home over time, you're going to build equity. Okay. Cash value in a life insurance policy is equity. It's the same concept. Boom. A lot of clients have a little light turn on right then. Would you rather build equity in your home or in your policy or not? And sometimes the answer is not. It's not that term is bad. Term is not bad. It's just different and you have to know how it works. But some people, when they understand the difference, would rather pay a higher premium for whole life because they know that they're owning and not renting. Okay, so it's a great analogy to use. It helps people understand it very easily. And equity is the cash value that's being built. So every time you make your mortgage payment, you're building equity. And that equity is an asset. Okay, it's an asset that you can use. Every time you make your premium payment in life insurance, you're building cash value, which is an asset that you can also use. Okay. And we call it permanent life insurance, which includes IUL and whole life. Okay. They both illustrate with cash value, works with either one. I prefer to show these illustrations with whole life because of the guarantees. They have much stronger guarantees than IULs, and that's the one we're doing here. So you can kind of adjust with whatever you're showing your client, but this is how I walk them through it. So you're going to pay in $1,496, which is total, or $14.96, which is total paid in over the next 25 years, going to come to $4,488. Okay. So your term policy will cost you $4,488. Now, here's the clincher: 98 or more percent of those policies do not pay out. So what I'll do is I'll switch over and I'll Google search percentage of term policies that pay out. Guess what you find? Over and over, 98, 99%. Okay. All the statistics show that fewer than 2% of term policies actually pay out. So do you want to do the lottery, right? That's really kind of what term is. That's why term is so darn cheap. Now, if people only need it for a period of time, they don't need it for the rest of their lives, and they like saving the money, term is awesome. If you're young and super healthy and you can get $500,000 for 20 or 30 bucks a month, awesome. Take it because it'll be there just in case. But you got to know that almost all of them, they don't pay out. This is how life insurance companies make their money, is they bank on the fact that a high percentage of people will pay in all these years and never take anything back. They don't have to write a check. Okay. So the nature of term, right? And we love term. Term is not bad, but they just need to know how it works. So, 58 years old, you've outlived your policy now. Very likely that you'll have zero death benefit, and now you need more life insurance. Okay, so press pause on that. Let's go over to a converted scenario. You converted a plan for $30,000. Now it's whole life, and now you're paying $37.98. I ran this illustration on a Foresters Advantage Plus, and I took numbers in from that illustration and plugged them in here. So $37.98, significantly more than term. But why would you want to pay more? All right, great question. Total paid in, instead of $4,488, you're paid in $11,394. And by the way, this is the guaranteed column. This is the non-guaranteed column. So this is the worst case scenario. And this is what I like to call the likely scenario, because insurance companies have been paying dividends, most of them for decades. Not likely to miss a dividend. Your money's not subject to risk. It just depends on the profitability and growth of the life insurance company, which they have had stable for a lot of them since they were founded, because that's how life insurance companies operate. They're very, very stable. So likely of having paid in $11,000. Well, you will either way, but the cash value is the next line item. Somewhere between $6,800 and $9,600 of cash value. So if I subtract that out, it comes to $4,600 on a guaranteed level in 25 years. I ran the cash value at year 25 and got $6,800. So you've paid in on your term $4,400. That's what it cost you. And if you subtract out the cash value on a whole life, it cost you $4,600. So at a very, very minimum, worst case guaranteed level, in 25 years, you'll have broken even with a difference of about $112, what it looks like, right? So it's almost the exact same of what you're paying now to convert to whole life. If you factor in the extra, all the cash value. Now, likely though, look at this. Likely though, you'll come out ahead. Here you're going to pay in $4,400. It'll cost you that. Here, after the cash value on a non-guaranteed, you're likely to have paid to this. It would cost you $1,700 instead of $4,400. That's a savings of $3,000 over the next 25 years. Nothing to shake a stick at, but you know what? It's $3,000. So would you rather stay on track or have a little bit of a discount? And at the very least, a break even. However, this isn't where the fun begins. This this is where the fun begins. This is just the beginning. This is, if it was just this and nothing else, not too sexy yet, right? But what happens on a whole life policy is you can do a paid up death benefit. Okay. And here's what I did is at year 25, I pulled the paid up death benefit. So if they do a reduced paid up and they say, you know what, I want to pay into my insurance no more. I am done paying my premium and I would like to just have an insurance policy that stays with me the rest of my life. That's called a reduced paid up. You cannot exercise that from what I know of any IUL company. So, but you can with whole life. And likely, it's going to be $18,000 of guaranteed, likely 26,000. So not only do you get the benefit of a cash value that you can cash out, but you can also exercise a reduced paid up benefit. Whereas here you have zero. So watch this. Watch this. So a person is 58 years old now. It's been 25 years. She started at 33, right? 58. Now she needs more life insurance. I took that death benefit and I said, how much would it cost a 58-year-old to get $18,377 of death benefit? Turns out that's $49.68 if she qualifies, if her health is adequate that she can qualify. We all know that can be a problem. 58, probably she's getting some final expense, but there's always that chance she can't. So you're going to pay him $49 a month, meaning over the next 30 years, and this is through Mutual of Omaha, which is our best price carrier for a final expense, $49 a month, $17,885. She will pay in additional premium over the subsequent 30 years. And over here, if you exercise the reduced paid up, you're paying zero and you still get that benefit. Over here, you're paying zero and that 26 keeps growing. So that could turn to 36, 46, whatever, right? And I only illustrated this at the 18,000, which is the guaranteed column. So, man, I'm being ultra conservative in my numbers, and it's still showing a savings of almost $20,000 for doing whole life versus term. Okay, interesting, right? I don't know if you've ever thought through that way, but it can be a huge benefit. Look at this one. If this person, 42 years old, converted a policy death benefit, even 50,000, so we're cutting it in half. Okay, and they can choose to keep the remaining amount. But I took the 50,000, ran the numbers. Look at that. He will have a reduced paid up benefit of 36,000, and that policy at age 70. $260 a month, saving over the next 20 years, $62,000. So here's really what's happening with this. And I can show you more examples. I've done several of these, but I just wanted to showcase a couple of them. What's happening is we're taking extra pressure from our retirement years, 50s and 60s. All those premium payments we're going to need to start paying, we're paying a little extra now so that we don't have to pay a lot of extra later. That's how I phrase it. We're paying a little extra now, so you don't have to pay a lot extra later. Either way, you're going to pay extra, right? Have you ever seen the movie Speed? Okay, that train is going down the track, the bridge is out. We know the bridge is out as viewers, and there's some people on the train, I think, from what I remember of the movie, who don't know the bridge is out, and they're living life. They're reading their newspaper, doing their thing, right? You could easily be on a train, not knowing a upcoming disaster, and until the train gets there, when it's too late. And people who have term, who haven't thought ahead and haven't planned for it, the day is going to come when they need more life insurance, and then they're going to get a quote and freak out. Well, the last time I got a life insurance quote, it was $22, and now you're telling me it's over $100? Yeah, because you aged. The two big factors in life insurance costs are age, right, and your health, including tobacco. Age and health; those are the two big things. And what I know is that nobody's getting younger, and almost nobody's getting healthier. We're all slowly decreasing in our health, and we're getting older. So today is the youngest you'll ever be and likely the healthiest. Best time to get life insurance, right? So when we show a conversion, or if you're talking about switching from whole term to whole, or doing a conversion possibly, they need to know that there's a potential problem coming up. In this case, it's going to happen at age 58. And we can switch that. We can fix that. We can fix it now, or we can fix it in 5 years, or we can fix it in 10 years. But now is when it's going to be the least expensive for you to fix that. Okay. So that's kind of how I walk through it. The other thing to note, and I'll actually, I think I walked you through this, that very, very few policies actually pay out. So renting versus owning, do you want to keep renting and risk not ever getting anything back from your coverage? Or do you want to switch over to owning an IUL or whole life where you're building equity, getting that cash value that can actually benefit you here, and exercise the option to do a reduced death benefit and actually own a life insurance policy that's paid up and never have to make another premium payment again? Which would you rather do? And so is it worth the extra money? And this is why. So what we're doing is we're justifying, or we're building value in the increase of premium. Because if a client doesn't understand term whole, $14, $37, same death benefit. Well, if that's all they know, and in a lot of cases that's true, well, $14, right? Well, why would I pay $37? That's more than double. That's almost triple. And in some cases, it goes up to almost 4 times the amount as you age. I think that gap, that difference increases. But 14, 37, what would you rather pay? Well, 14. That's why everybody buys term. That's what, or so many people, is because they fall in love with the price. But look ahead at your long-term prospectus and see, does it make sense in the end? And if you follow through with those numbers and build in cash value and look at the option to reduce pay up, a death benefit, and how much that's going to cost you for the rest of your life, and factor all that in, by tens of thousands of dollars, and in some cases, 62,000, that was a big one, you're saving a lot of money by doing whole life versus term. So one's going to be cheaper in the front end, not likely to ever benefit you. One's going to be more expensive on the front end, but if projecting out all the numbers and everything that happens, when people see this, a lot of times they understand the value and they'll go with what it works best. But at least we're educating them, right? At least they know. And in worst case scenario, people can start with the term, and in a couple of years, when they have more funds, they can convert at that point. So I just wanted to help you walk through that scenario, because I don't know if we take the time to explain that all the way out to a client to help them understand their options. So anyways, take it for what it's worth. If that's helpful to you in your next presentation, and I don't bring that up, especially mortgage protection appointments. I don't really usually get into that level of detail, but when I'm on an ethos appointment, or if I'm doing a policy review on a friend or even a client, this is some of the discussion that I'll get into. Is, now I notice you have term. Has anybody ever walked you through the difference between term and whole life? Well, no, not really. Okay, perfect. Let's go through that. I want to make sure you understand how it works and what your options are. So really quick, and then I'll switch over and we'll jump in and I'll share the calculator and walk them through that. So hopefully that's helpful to you, and you can use it sometimes in some of your upcoming presentations and things. If you have any questions, feel free to reach out. But appreciate you listening. I hope it's helpful, and make it an awesome week. And I'll see you around on the next one. Bye.